COVIDCASTJA. Welcome. I'm your host, Rochelle Cameron. And today we're going to be talking about a very important matter. We're getting right into how to create and read business financial statements. Because we're good at starting businesses, and a lot of us fail because we have not been keeping proper records. And when we're trying to get something like a loan, or sometimes we're entering into particular arrangements that they'll ask us for financial statements, and all of a sudden there's silence and crickets because we are saying to ourselves, but we don't have no financial statements. Some of us, the financial statements are done by others, and we're not really quite sure what's in there, but if they say that it looks good and it's all right, we sign off on them. But today, we're saying to ourselves as business people, it's important for us to actually understand how our business is performing. You can't make decisions on your next steps if you do not know how the business is performing. This week, we have created a fantastic memo, Financial Statements for the Beginner SME. If you do not have that memo, it probably means that you have not emailed us your information so that you're on the list. So stay informed with the PSOJ, get the weekly business tips memo, email us at sme@psoj.org. So today's show will be very lively. I know sometimes when you hear financial statements, you have to stifle a yawn. If you're stifling a yawn, please get up and shake off yourself, because if you don't know anything about financial statements, today you are going to learn a lot. I have my pen and paper ready because I too will be taking notes. So we have two fantastic guests, Mr. Marc Gayle, and Marc Gayle is a financial professional who is also an SME. So he comes to us today with a background as a business person and as a financial expert, and he's taking us through his process and helping us to understand from a business perspective how we look at these financial statements and what they're saying to us. And then we have the flip side of it, an actual chartered accountant, Mr. Paul Cole, and Paul Cole is going to get into some nitty-gritty discussions on what do investors look for in financial statements, because as we grow our business and we're seeking investors, some of us have pivoted our business and we need additional investors to grow that business. What will the investors be looking at? So please just get yourselves ready, and please take out your notebook and paper. And those of you who are very techy and have to type on your iPad, get everything charged up and ready, because today you will be getting a fantastic online course on how to create and read business financial statements. Last week, we were joined as in the host chair by Mr. Nevada Powe. So I haven't kicked him off this week. He's back with us. Nevada, welcome.
Thank you, Rochelle. Welcome back. Welcome back. I hope you took care of whatever business you needed to when you abandoned COVIDcast.
Wow. You're too fast. So we just want to thank Nevada. As usual, he did a fantastic job, and there was a great discussion last week. And I thought it was so important for Nevada to be on today to set the stage, because throughout these several weeks, Nevada keeps harping on the same thing. How is your business performing? How do you know how your business is performing? Do you have the proper records in place? Do you even know how to read your financial statements? So Nevada Powe is the lead architect for the PSOJ SME project. And as many of you know, he is Harvard trained and has worked on Wall Street and is back home in Jamaica, pretty much contributing to growing this nation. It's all about growing Jamaica, and we're growing through COVID. Nevada, what do you expect our viewers to get out of this episode today, and why is this topic so important?
Okay. About 3 or 4 years ago, I was helping a Jamaican business actually do their strategic plan for the next year and do some projections. It was what you call a large, medium-sized business. So they're between $300 to $400 million a year. And when I was sitting there with the CEO, sort of I'd done the projections and we're talking about the thing. And then we were saying, and I was saying, but let's do a projected balance sheet as well. And I'm going through it and I'm realizing that his face looks a little confused. And I said to him, you don't know how to read a balance sheet. And he's laughing and said, no, to be honest. And the accountant does it. And I just say, and I sign it off. And I realized that numbers in general, by the way, because we don't do math well, numbers are scary. And then, of course, finance, which is obviously built on top of numbers, can be even scarier. So I sat down, no problem. I walked through it and explained to him what a balance sheet was and how we adjusted the balance sheet and how we do projections and so on. But I also recognize it comes with such fear that people don't even necessarily ask the questions. So what the real thing that we need to emphasize tonight is this. Don't think that you not understand finance. Plenty people have businesses and don't understand finance. And I say that to give yourself the permission, if you're with your banker, if you are with your accountant and you don't understand something, ask for it to be explained. You're paying these people money. And if you still don't understand after them tell you the third time, ask the fourth time, because that's the only way you're going to learn. I'm really going to encourage you to get the memo this week, because again, it's very detailed. And also what we do at the end of every memo, if the memo itself is not enough, we always pull together some online links around courses, around videos, around all kinds of things. So we recognize that the people learn in different ways. Some people can read, some people can do video, some people need many times need to go back and hold things and stuff. So what we want to make sure we do is provide a big platform of options for you to be able to learn the stuff. Remember, our goal is when we are done with COVID, you will be a better business person because you took advantage. The numbers, the financial statements are the window into your business. This is why you will know whether you're growing or shrinking. Or actually what is very, very common, people are running a business and realize they come to the end of the year and they don't make any money. And just go again another year and they're running the business exhausted, they don't make any money. And they actually don't understand why. And sometimes it's as simple as the fact that their pricing isn't above their cost, and they haven't realized that they're badly pricing their business. And sometimes it's just looking at the numbers and asking questions where you're able to then understand what exactly is has happened. So I'm very excited about tonight. As you said, a lot of people roll their eyes, but try not to roll your eyes. We have specifically designed this course tonight to start from the assumption that you don't know anything. And we start with Marc Gayle because he's looking at it from us as an SME. Plus, he teaches beginning finance for SMEs. So that's a nice segue. And then for those of you who do investing, we're going to talk to Paul Cole later about how do you look at them big company income statement and balance sheet and look at ratios and all that kind of thing. So it's two different avenues. If you're an SME or a student or someone just interested basically in finance, by the way, doctors, lawyers, you need this stuff at the base level, right? Marc,
you're word, man. You're throwing word.
Exactly. Marc is the starting point. You're going to talk about a coconut jelly business.
So we're going to welcome Marc shortly because, as you've mentioned, we're looking at it from two different perspectives today.
Absolutely.
But talking about the same thing, but just looking at it through two different lenses.
Yes.
For somebody who is taking notes today,
yes,
what particular things should they be paying attention to? And remember, you may not understand everything today, you're not a financial expert, but today we're getting to open that window to your business so you know the questions to ask and you know what else to be researching as you are opening that window wider. So what particular notes do our SMEs need to be taking today as they're hearing this information to look back on their numbers?
Here's the thing, and Marc will definitely start with this, right? The three fundamental statements of your business. What is an income statement? And what does the income statement tell you about what's going on in your business? What is a balance sheet? When I'm talking about assets and liabilities, which is what you own versus what you owe. But try and understand that is also very critical because that will tell you if you're actually creating value year after year or losing value. And last but not least is the cash flow statement. The cash flow statement, many months ago, we talked about working capital, which we'll get to our working capital discussion tonight. And this whole notion that you can literally grow broke. If you're spending your cash ahead of when the money is coming in, you can end up owing and not having the money in. And therefore, the cash flow statement allows you to keep honest with respect to not growing so quickly that you're out of cash. So watching your cash position of your business is very crucial. What's the income statement? What's the balance sheet? What's the cash flow statement? And what do they tell you when you look at them? And how do you read them? If you get just that, we are in business. And there'll be more that you will get. Thanks, Rochelle.
Thanks a lot, Nevada. And Nevada will be joining us again at the end of the show for us to do a little wrap up on our learnings from today. But right now, we're going to be joined by Mr. Marc Gayle. So Marc has 2 decades of financial experience, ranging from trading currencies to leading fundraising efforts for SMEs and entrepreneurs. He's very involved in the local tech community and enjoys helping fellow entrepreneurs build their dream empires, while he, alongside his 2 business partners, build their own company, TCP Tings. You know, when you see those bags out there, that one bag of things, TCP Tings. Marc is an educator and teaches financial analysis classes to help Jamaicans create wealth for themselves and their families by learning how to analyze and invest in companies. Marc has an MBA from the University of Tampa and a BA in computer science from Eckerd College. Welcome, Marc Gayle, to the show. Hi, Marc. How are you?
Oh, wow, Rochelle, thank you very much. What a rousing introduction. I hope I can live up to that.
You will more than live up to that, because Marc really comes to us from so many different angles today. And it was very important for us to have an SME who also understands how to break things down. And Marc is running a company. He teaches people how to actually read these financial statements. So Marc is really coming to us as an expert SME today. So Marc, again, welcome. Now, Nevada talked at the top of the show about these 3 particular statements: the income statement, the balance sheet, and the cash flow. And when we were talking earlier, your fundamental thing is you need to know how much cash you have. Exactly. When I talk to Paul says the same thing. And a lot of business people will say to you, but I know how much money is in the bank. I know how much I think the light bill should be for this week and things. No, man, I have money. I have money. But if you ask them for a financial statement, or were you to do a financial statement on their behalf, many of us have no idea what these numbers are really showing. So Marc, let's start with the basic. What is an income statement?
Yes, so I mean, everything that you've described and what Nevada spoke about, Rochelle, is, you know, completely on point. You know, in my experience, a lot of people, they get intimidated by this, right? But, you know, really simply, an income statement simply just tells you, you know, what revenues the company earns or you earn, what expenses you incur in the pursuit of earning that revenue, and then the difference, you either have a loss or a profit. So we see it on the screen here. It's actually very hierarchical, right? So it starts at the top, all your revenue, all your income streams go at the top, and then you deduct all of the expenses from that. And then the difference gives you a surplus or a deficit, and that gives you your profit or loss.
Okay, so Marc, for those of us who are not completely familiar with what, like a basic income statement, if we set this kind of stage, because a lot of SMEs are persons who still are earning a salary,
right,
or they're currently earning a salary and they plan to segue into the business. So they have a salary coming in, and then, you know how we have the side hustle. So that's a nice basic thing. And I know you've kind of looked at that basic scenario for most of the Jamaican SMEs, that we have, you know, 2 little things are run on the, you know, the job and the side hustle.
Exactly.
But we still can't understand why we have work and we have the side hustle and we're still not making any money. Can you take us through what because we see revenue, expenses, and profits, and we're like, no, if we're making any of those, what does that income statement look like? Talk us through one.
Right. So basically, so what I did is I kind of thought through, all right, what's the simplest way we can explain, you know, what this an income statement looks like? And so if we can show the slide really quickly. So imagine you have Jane, right? And Jane earns a monthly salary of $150,000. But Jane also owns a jelly cart, right? And the reason that she owns a jelly cart is so that she can earn additional income. Well, so what you would simply do is that, you know, she goes to her job and she earns $150,000, for example, you know, from her job every single month, right? So that's the first income line on her income statement. And then below that, every month she sells about $25,000 worth of coconut jelly. So when you add both of those together, that gives Jane her total income, right? So at the top there, the income or revenue, we know that, okay, in any 1 month, on average, Jane makes roughly about $175,000, right? Okay. So that's what that first, the first block on our diagram shows us. How much money on average does Jane or Jill, earn? Then now, when you go, now we've captured all of the income, right? And so in the top section, you capture everything, right? So if it is, if you sell phones or you sell phone cases, or you do freelance gigs on the side, for example, all of that goes in your income statement. And again, this is from a personal basis, right? Yes. Then you look at your expenses. So you have rent, you have JPS, you have NWC, you have to buy groceries. So you look at everything that you spend money on, and then you add all of those up, right? And so you itemize each one, and you put them in the expenses portion of the income statement, right? And so here we've done it, so we have rent, we have utilities, groceries, coconuts. In this case, remember, Jane has a jelly cart, so we have to factor in, all of the things that she needed. So, her straws, her well, I was gonna say plastic bags, but we're kind of past. I don't know how to do it. I guess maybe they just bags. Yeah, chop the coconut. No, paper bag don't really work. So maybe just chop the coconut and put a straw in, right? So you have straws, right? And then all of the other expenses that she incurs, transportation and so on. And then you sum up all of that and you get your total expenses. And then after you have your total expenses, in this case, Jane, her total expenses came up to $150,000, even after she set aside $20,000 for savings. And then when you subtract the 150 from 175, you have a difference of 25,000, and that becomes the surplus, right? So
when Jane looks at her surplus, is it that Jane should look at her surplus and say, yeah, we're rich, we can go out dinner for the weekend, or maybe I should buy a new car? If Jane is in the business of coconuts, so when she sees a surplus, what are some of the kinds of what does that surplus tell her about her business, and what decisions should she be seeking to make given that surplus?
Yeah, great question. So all of this comes down to what Jane's goals are, right? Like if Jane wants to sell more coconuts, or increase her income generally, then one avenue that she can take is that she can invest in more coconuts, or maybe she can purchase another coconut cart, right? Or she can do something else. She can invest in marketing, for example, to bring more people to the corner that her coconut cart is at. So what it boils down to is any surplus that you have after you've covered all of your expenses is up to you to decide how you allocate it, right? You can either spend it if you want to go bathing and want to go go shopping or whatever. Sure, that's up to you. But if you want to grow and grow your income, then it is advised for you to invest in yourself. And in this particular case, in Jane's case, she can buy more coconuts, or she can buy more coconut carts, or maybe she hires a salesperson, or she hires another jelly man, or all these different things to improve the process and improve the customer experience and improve the amount of coconuts that she sells.
Okay, so that one was we can do that one, so we can set out our income or expenses, and sometimes it's a little scary to see the number that comes out at the bottom, whether it's in the red. And if you actually do it on an Excel spreadsheet, some of these templates make it red, so know for sure. That's not a good place to be. So you've worked through your income statement, and a lot of us just stop at that income statement.
Right.
Now, the dreaded balance sheet, which many people just don't understand a balance sheet.
Right.
Can you tell us a little bit about balance sheets and the relevance of the balance sheet?
Sure. So what the balance sheet tells anybody that's reading it, right? So a banker or an investor or a partner or an employee, all it simply tells is what is the financial health of the company or this individual, right? So and the way you determine that is that you total all of their assets, so everything that they own, right? So we're going to go into it a little bit more, but basically every single thing that is owned by the individual or the company, those are your assets. Then you have all of your liabilities, everything that you owe, right? So, any loan payments that you have to make, all that stuff, all of that goes in the liability section. And then the difference between the two is your equity, your shareholders' equity. And all that simply means is that is, so equity is just the difference between your assets and your liabilities. Is something that you can literally take to the bank and you can convert to cash if you would like.
Okay. So can you show us a simple balance sheet so we can wrap our heads a little tight?
Sure. Yeah. So if we were to dive into Jane's balance sheet, if we get the next slide, here we will see. Okay. So again, remember from the income statement, we had transportation as a line item on it, right? So one of the things that, so Jane, she has a car, right? And so she has to, obviously she drives to work. Well, no, she may, do work from home, but she definitely has to drive to the corner that she sells her jelly on. So she owns a car. She bought a car, but in order to buy the car, she went to the bank and she got a loan. Well, her car, when she bought it, it was valued at $1.5 million. So here we simply have the car on the left hand side. So that's an asset, and it's valued at $1.5 million. We also see that her jelly cart was valued at $250,000 the last time it was valued. Right. So when you add both of those together, you get $1.75 million. So that tells us that Jane has total assets worth $1.75 million. But remember, she has a car. She has a car, but she used a loan to buy the car. Right. So in this particular instance, because she has a loan, she owes the bank or wherever she got the loan from, she owes them $1 million. So that's a liability. So we put the car loan on the liabilities section, and then we'll put the amount. And so then in this particular instance, her total assets are $1.75 million. Her total liabilities are $1 million. And so when you subtract the $1 million from the 1.75, you're left with $750,000, which is effectively her equity, which is also her net worth. That is the total amount that she is worth.
Yeah. And that whole concept of net worth, and audience, we are saying you're all worthy, but sometimes your net worth is actually below zero.
Right.
So this whole concept of net worth, the balance sheet actually shows the net worth of your business. Exactly. So it's showing your assets, and you're taking the liabilities from those assets, and what is that business really worth. And that's a very important financial statement that investors will look at, and that as a business, because as a business, when you look at the balance sheet for TCP Tings, what are you, and you see a positive net worth, what are you getting from that? Because our viewers, when they see it, what it mean? Okay, so I have a net worth of $750,000. What that mean?
Yeah. So what that basically means is that well, for starters, you are a going concern, meaning that your business can continue running. So every single year or every single period, every single month, you are not accumulating a deficit. You are accumulating a surplus, so you can continue operating, right? And then, once you have your balance sheet, it tells you whether or not you're investable. Can somebody, expect a realistic return if they were to invest, in your business, or can they expect to be repaid back their money, right? So if they give you a loan, can you realistically manage the loan, right? So if you think about, Jane's case with her $750,000 net worth, if she was to take on a loan of, say, I'm just going to use an extraordinary, ridiculous number, but let's say $7.5 million, an argument can be made that, okay, based on her balance sheet and her income statement, she can't support a $7.5 million loan, right? So, but, based on all of this, perhaps she can support, a $750,000 loan, right? So the balance sheet tells you, it gives you a snapshot of what your personal financial position is at any moment, at the time that you prepare it, so that any financial partner or any partner that is looking to do business with you can determine how is what's the best way that they can go about doing business with you, so both of you can benefit.
Okay, thanks a lot for that. So viewers, you see this balance sheet, because some of us are scared of this concept of a balance sheet. Do you understand that sometimes when you see it in a very simplified form, you recognize that the balance sheet is nothing to be scared of, but it is a very important document to wrap your mind around to understand the current value of this business. So as you're making decisions, you know what the value of the business is, so you're able to make more informed decisions. And Mark, you mentioned this whole concept of a going concern. And we've been talking a lot about this cash flow statement. We need to delve a little bit in the cash flow statement, because you know how sometimes we stay when we see cash and so, or you know, we look and we say, I have my money, and we are not necessarily looking to see what does this actual cash mean for the business at a particular time. So tell us a little bit about cash statements.
Right. Okay. So the cash flow statement it's basically what it chronicles are the operating activities. So how much cash is generated by operating. So in this case, in Jane's case, it is selling coconuts. You know, it is how much cash is generated by investing activities. You know, so when you take your money, put it in the bank, and you earn interest on it. You know, that is, you know, income from that is, you know, cash flow from investment activities. And then financing activities is, you know, did you get a loan or did an investor invest? Now, one of the things that I want to kind of connect with what you said, Rochelle, is, you know, if you have, there is a distinction between, between cash and revenue, right? Yeah. Not because you earn revenue means that you collect cash. So for example, let us say, you know, as a SME, you know, you signed a contract with a government agency for $10 million, for example, right? Yes. And it's a year-long contract. Well, that does not mean that you have $10 million in the bank today. That doesn't mean that. You know, what, based on typically the way a lot of these contracts work is that you have milestones to hit, and then as you hit those milestones, then you will get paid, right? Yeah. And then even once you get paid according to the contract, you may submit an invoice, but then you don't receive the cash for 30 days or 60 days or 90 days in certain situations, right? So the cash flow statement, so even though you've you know, earned $10 million, yes, you haven't collected $10 million cash, right? So the cash flow statement tells you, as at this date, how much cash has the company, you know, taken in from what sources, and how much cash has the company expelled or spent, and you know, from what sources, right? Because the cash flow, the business cannot survive without cash. Just like, you know, as an individual, if you lose your job, you know, God forbid, and Jane's salary, you know, her $150,000 salary goes away, well, immediately she has to think about, okay, how am I going to pay my bills, right?
Exactly.
And just to bring it home, in Jamaica's case, you know, when a lot of people, you know, were laid off as a result of COVID, right? One of the things that the government rolled out is a compassionate grant, and different types of grants, right? So in that instance, that grant, when you get it, it would show up on your cash flow statement, right? And we can actually go into, you know.
Yeah, because I think the cash flow statement, and you made a very important point. In several instances, we just have in the back of our minds the contracts we've signed and how much we are expecting, but the actual cash that we have available, and I wanted to touch on working capital, because you know, say it's cash we have to pay, like we staff with.
Absolutely.
And when Jane buy the extra coconut from the man with the coconut tree, she actually going to have some cash. So talk us through a cash flow statement.
Right. Okay. So if we bring up or Jane's sample cash flow statement. So if you think about another way to think about cash flow statement from a personal perspective, it's kind of like your bank account, right? Like your bank account doesn't really you know, tell you in an organized way, you know, your income and your expenses and your profit. Literally all it shows is your inflows and your outflows, right? So it shows your opening balance and your closing balance. So if you think about, you know, your personal bank statement from a personal perspective, that is effectively similar to what your cash flow statement looks like, right? So you know, in Jane's case, you know, she has the opening balance of $50,000, right? And you know, meaning from last month. And then in this month, she earned $150,000. So you see that balance goes up to $200,000. Then, you know, she had rent to pay $40,000, JPS $15,000, and so on. So you see all of those outflows. And then she gets the cash from her jelly sales. And we see that deposit there at the bottom. And then she did an outflow to her savings, right? And then that at the end, here we have the closing balance. And that shows us, okay, at the beginning of the month, she started off with $50,000. But based on all of her activities, she ended up with $75,000 at the end, right? So this is a very, very simplified version of, what the cash flow statement, would kind of, the information it would tell you. Because, at a glance, it tells you, all right, how much cash did Jane collect from operating activities? In this particular instance, it didn't tell us the
Let's go back on that slide and kind of break that down a little bit more for me, Mark.
Sure.
What would now be the operating activities versus the investing activities? Tell us a little bit more about that.
Right. So in this instance, Jane's operating activities would be her salary, right?
Yeah.
So the $150,000 inflow. It would be all of the activities that are like all of her outflows, so the transfer to landlord and so on, all the way down to car payments, and then also her jelly sales deposit, right? So all of that is her operating activity. Now, the savings transfer, that is an investing activity, or we're just using it as an example here. This is an example of what an investing activity would look like, because here she is making a decision to take $20,000 out of her account or out of her business and send it to a savings institution so that she can earn interest. If, for example, last month she had earned, $500 on her savings, then she would see a $500 inflow from her bank account, and then that would have been also investing activity.
Okay. So Mark, we got a comment too that in terms of, because we've actually done a slide that mixes her salary and the coconut sales together, but certainly in the real life scenario, and we're going to be looking deeper into financial statements too with a chartered accountant, just to make the point that you, as a business, it's very important to separate your personal funds from your business funds.
Absolutely.
You want to touch on that a little bit for us?
Yeah, man. Yeah. So the core thing that we're trying to do here is just to teach a principle, right? The principle is that, if you have an income statement, the income statement lists all of your income and it lists all your expenses, and the difference is your surplus, right?
Yes.
But you're absolutely right, Rochelle. When you're starting a business, you want to segment them and keep them separate, right? So to be more proper, what would happen is that Jane's jelly cart income and expenses would be different than her monthly normal personal income and personal expenses.
Yeah.
We're
going to be viewers. We are going to be looking at actual financial statements a little later down in the show. But what we wanted to do today is to set the stage, because sometimes when you start with the university part of it, you actually miss the learning. So what we've gone through the income statement, and the income statement looks basically at your income and your expenses. We've also gone through the balance sheet, looking at your assets and your liabilities, and we've gone through the very important cash flow statement, understanding what your cash flow position is. And Mark, I can't ignore this question, because Shelly-Ann, and I know it's a question a lot of people have, Shelly-Ann says, good night. Sometimes the businesses are not really making a profit or are performing below potential. Could that be that some expenses could probably be managed more efficiently? Therefore, the financial statement also guides them.
Absolutely. So you're absolutely right, Shelly. And the first step, put it this way: if you don't know how to read the financial statements, how can you possibly know if you're profitable or not? And also, if you are, profitable, in what way, right? So
yes.
Going through the exercise of documenting, like actually writing or working with your accountant, or even just doing it yourself and categorizing all of your income and all of your expenses, that will tell you a lot, right? It will show you, oh my gosh, this, my rent expense, for example, is just way too high for my income. Maybe I need to move, and then just changing location, that could boost your profitability. Or maybe it may tell you that, my coconuts. So, you may be buying, $22,000 worth of coconuts, but then, you're only earning $25,000, right? So when you break it down and you look at it like that, once you document it, it will tell you a lot of things, right? And so one of the things that I really love about finance and about learning how to read financial statements is that it really opens your eyes to not being blind anymore. Like once I learned how to do this, like I felt like I could see the world completely different.
The window of your business was opened up, as Nevada mentioned. Christoph Ellis, asked a very interesting question. Christoph says, should you be worried if a similar company in product and size has a much higher net worth than yours?
Boy, that's a good question, Christoph. I would say definitely not. That's not a cause for concern, right off the bat. To be frank, once you're starting out, almost every other company is going to have a higher net worth than yours for the most part, unless, except for the companies that have a negative, right? So if you're starting at zero and company is at negative, then, they're worse off. But I wouldn't focus on that. What I would focus on is, okay, how can I create value? So how can I make something that customers want? And more importantly, how can I make something that customers are prepared to pay me for significantly in excess of what it costs me to produce it? Because the only way you can accumulate a surplus, profit, and I know some people think profit is a bad word. It's not. Profit is one of the purest things, on the planet, because it tells you that you're creating value in a sustainable way and that you can invest in your business. You can invest in improving your product quality. You can invest in paying your employees more. You can invest in, better business processes, so your customer service is better. And so, you can't do any of that stuff if you're not generating profit. So,
and you won't know if you're generating profit and what your actual net worth is if you have absolutely no idea what your
if the window is closed or the curtains are drawn, you have no clue. And so Christoph, I would just tell you, focus on your focus on the market, focus on the product. How can you create value? A lot of times, a lot of these larger companies, they have blind spots that they can't respond to, or they can't properly satisfy the market in a way that you can. So even though you're small, it may seem like it's a disadvantage, but you have to look for the ways that, okay, how can I leverage my size to as an advantage? And quite frequently you can, and size doesn't always mean better.
Exactly. Marc, thank you so much for, you have really opened many eyes today, not just the importance of the financial statements, but what is actually in these financial statements. And as I said earlier, Marc was giving us that nice breakdown of it, because sometimes when we start too high level with all the line items, we completely miss the importance of these documents. So Marc has taken us through a simplified version of an income statement, the balance sheet, and the cash flow. And these, Marc, are the three main statements that a business person needs to know.
Absolutely.
So thanks a lot, Marc. And Marc is going to be around with us for a little longer. But Marc has set the stage, because those of us who like cricket, say always have, you have the opening batsman. So Marc, take away, and him gone a solid century for us. So we're going to welcome at this time Mr. Paul Cole. And Paul Cole is a practicing chartered accountant, and he's CEO of PCA Chartered Accountants and Business Advisors. And earlier we got a question that some business people don't understand the line items, and Paul is going to talk us a little more through the line items in actual financial statements. Paul has over 25 years of experience in finance, business operations and strategy, mergers and acquisitions across a broad range of industries. Paul's many accolades speak to his significant competency, including being a fellow of the Institute of Chartered Accountants of Jamaica, fellow of the Association of Chartered Certified Accountants in the UK, and holding the Chartered Global Management Accounting designation. That is, by the way, just naming a few. In recent years, Paul he has segued into becoming an educator, tutoring corporate finance, strategic management, and other subjects to MBA students at his alma mater, University of Manchester in the UK. So, ladies and gentlemen, know that, as we say in Jamaica, Paul is no kwashi. Paul knows his stuff. So, Paul, thank you so much for joining us this afternoon. And you are going to be delving a little bit deeper for us into the financial statements, and in particular, how we actually look at financial statements to decide whether to invest. So, many businesses there are several IPOs that are going around, and some of us have bought stocks, and when we get the annual report, we're just looking at the pictures and we're not turning to the financial statements, which is really the cusp of the annual report. So Paul is going to talk us through some financial statements. And Paul, I just want to jump straight into it. Marc laid the foundation with the income statements. All right. So I want to ask just a basic question. How can I tell if a business is healthy or not?
Good evening, everyone, and thank you very much for having me. Marc touched on the statement of cash flow. Statement of cash flow is fundamental to the health of an organization. Many of you viewing at this moment might be too young to remember something used to be called a fund flow statement. It used to look similar to what we now know as a statement of cash flow. Would you believe that when I was doing my studying for my qualifications, I did not do a cash flow statement because of the fact that at that time it was fund flow statement. What was happening around that time is the fact that many companies were being given a clean bill of health by the auditors, and within 3 to 6 months' time, they went belly up. And the regulators said to themselves, hello, what is happening here? And when they looked around, they saw that cash was an issue. So the company was given a clean bill of health by the auditors. 3 months, 6 months down the road, it went belly up. And that is what brought the statement of cash flow into being. As a matter of fact, the statement of cash flow is about 30 years old. It is young in the context of accounting. So I want to emphasize.
Statement of cash flow has actually come out of a recognition that the cash flow position of a company is very important for us to understand the health of a company. So we weren't understanding it before.
No.
So before we get into that, I want to go through each of the statements with you again too, so that we're understanding what each of them are actually telling us about that health position. Can we look at the income statement?
Okay, so the income statement really is, as Marc mentioned earlier, it is giving us a statement of the revenues and the cost. In this particular in this particular income statement we're looking at, so we can see sales, cost of sales, and gross profit. Gross profit is a very, very important part of the income statement because the fact that it's measure the extent to which we are controlling our pricing or having some impact on our cost of sales. Generally speaking, so if I were to generate a gross profit margin of 20%, in layman terms, this means that for every $100 in sales, I am generating $20 in gross profit margin. So I want to make my gross profit as high as I possibly can. So I need to be able to control my cost of sales. And it gives me some clues with regard to how I'm pricing. Operating expenses, these are the general operating expenses. So we're looking at wages and salaries, utilities, and so on and so forth. And the net profit before tax. And I always like to look at net profit before interest and tax, because the fact that I want to see the extent to which I'm using debt capital to generate earnings. So I like to see my net profit before interest and tax, because the fact that the reason why I went to borrow money is because the fact that I want to use borrowed money to make money and also be in a position when I pay back the interest and the principal, I have some money left over for myself.
Okay, so we look at that net profit before interest and tax.
Yes.
And then So that gives us an indication that that's a kind of financial health checkpoint to that net profit before interest and tax.
Yes, and the reason for this is because the fact that when I go to the bank and borrow money, my primary objective is to use that money to make money sufficient to enable me to repay back the bank and have something left over for myself. So therefore, the profit before interest and tax tells me how well I'm using borrowed money. I have no control over tax rate. The tax rate is set by the government. So it's important for me to look at all of this before tax.
Okay, so when I'm looking at an income statement for a company, I look at that net profit before the interest and tax, and then the interest on the debentures is the interest that's paid on the loans.
That is correct. That is correct.
Okay.
Yes.
And then that would now give me that net profit before tax, and then I subtract the tax from that.
Indeed, indeed, indeed.
Okay, so if we go back to that income statement, as an investor, the profit after tax, we look at that profit after tax, because a lot of times now we reach down to the tax part and we understand the net profit before the tax, because a lot of these things are a little more intuitive, and then we get the profit after the tax. Tell us about the dividends and the retained profits. What is that telling us about the business?
Well, basically, when for the ordinary shareholders, i.e. the equity shareholders, all of this profit after tax belongs to the equity shareholders, because the fact that we have taken out the interest, which is paid to the debenture holders, who are, these are equivalent to bank loans.
Yes,
so I've got to pay the interest on my loans, irrespective of the amount of profits that I make. So when I've taken out all of that and taken out the taxman share, I am left with profit after tax. So in this case here, the 200, all of that belongs to the equity shareholders. Now, the directors will have policy as to how much of the dividend, how much of the profits is given out as dividends. So most companies, they want to hold back a proportion of the profits to invest in further profitable projects, so to generate future profits. So the dividends paid, it be the policy derived by the directors. So some companies may say that their payout ratio would be, say, 50%. In this case here, they're paying out 70 out of the 200. Yes? So this is very important in terms of looking at the extent to which the company is keeping back an element for.
Yeah. So you always want to also understand, when you're investing in a company, you want to get an idea what the dividend policy is, so that you can understand what percentage of that profit after tax will be paid as dividends. And then when the dividends are taken out, the retained profits are what the company would now have to continue its investment and growth, etc.
Reinvestment. But bearing in mind that there are some people, some investors, they want dividends right away, whereas other investors, they want appreciation of shares. So when a company holds back a significant proportion of their earnings rather than pay it out in dividends, if it is quoted on the stock exchange, the signal is that there's going to be an increase in the value of the shares. So some investors will forego immediate dividends for appreciation in the value of the shares.
Thank you very much for that, Paul, because that's very important for us to understand. Because sometimes we flip past that and we are looking and very focused on a dividend policy and not looking at the flip side of that. So thanks for that. So tell us a little bit. I want to go now to the balance sheet, because we're getting a lot of commentary. The balance sheet, of course, is the one that we know we should look at, but a lot of times we're not understanding it so well when we see the company's financial statements. What are we looking for in the balance sheet?
You're looking for liquidity. Liquidity. Basically, I'm looking at the current assets versus the current liabilities. A company can be making considerable amount of profits, but if it's experiencing liquidity problems, it could go belly up. You remember when I told you about prior to the cash flow statements coming into being, we had something called a funds flow statements, and the companies were being given a clean bill of health by the auditors and subsequently going belly up within 3 to 6 months. So it's important that there is sufficient working capital to ensure that day-to-day the company can meet its day-to-day obligations as they fall due. For example, let us look at that figure called stock. It may be the case that if you drill down, it may be that a considerable amount of that stock is obsolete, especially in this day and age of fast-moving technology.
Okay.
Trade debtors. If you drill down there may be considerable amount of that trade debtors over 90 days. You may not be able to collect. Yes.
So Paul, just for those of us who don't understand what a trade debtor is a who again?
Basically, I sell to my customers. Yes. And I give my customers 30 days to pay. And the customers, all 90 days, they still haven't paid. So the longer it takes for them to pay, the higher the probability that I will never, ever collect. But yet it's on my balance sheet, and it's already shown as a profit in my income statement. So if I'm unable to collect, then I am unable to pay my suppliers. I'm unable to meet my day-to-day obligations. And because of the fact that I am unable to pay my suppliers, my suppliers might stop making supplies to me. I was with a client earlier this week, and I heard it on the phone trying to collect from a customer. And the customer said, look, because of this COVID, I am experiencing considerable amount of challenges. I can't pay you. And the client said, okay, then you can't pay me. I'm going to stop supplies. I'm not going to be able to supply you anymore. So you see the connectivity between.
So let's look back at that balance sheet, because that whole concept of the trade debtor, because we keep talking about how important it is to understand the cash position of a company. Yeah. And somebody asked a question earlier, and we there is another section to this balance sheet. Yes. So just before we go to that other section, in this COVID time,
indeed,
should we be paying close attention to that trade debtor line item?
Yes. I mean, COVID is a game changer in all of this. So, for example, on some companies' balance sheet, huge amount of trade debtors, they'll never ever collect it, never, because the fact that some of those companies that are owing them money have gone out of business. They've gone out of business, so they'll never collect it. So this trade debtors that is shown here, you could actually just wipe it off because of the fact that some of the customers have gone out of business.
All right. So let's look at the other section of the balance sheet.
Okay. The other section of the balance sheet, the area in which you want to focus on here is debt. Yes?
Okay.
So long-term debt we're talking about here, because the fact that
so hold on a second, Paul, because you remember me not bright like you know. So where on people tell me about that long-term debt? Where I find that?
The 10% debentures. 10% debentures. Okay. Yes, that could be substituted for long-term bank loans. Anything, whenever I use the term debt, I'm talking about long-term debt. Debt over 1 year.
Okay.
That's below 1 year's current liabilities. Yes.
So we should be paying very keen attention to that particular line item too on the balance sheet.
Yes. And the reason why you should be doing so is because the fact that you've got to pay interest on that, irrespective of the profits you're making.
Yes.
And if you are in a volatile trading condition and your business is vulnerable to the swings in the economy, you've got to pay that interest irrespective of the amount of profits you're making. So it could be that you're not generating sufficient revenues or earnings to be able to pay the interest. And again, the bank manager might say, all right, then I could renegotiate the bank loans with you. We could restructure this. But if it's the case that the environment in which you're operating is such that it's very unlikely that you'll be able to recover soon, the bank manager would come in and said, look, when I lent you this money, you had personal guarantees, you had your house, your personal possessions. I am going to now come in and recover my debt by selling those personal possessions.
So we really do have to look closely on these balance sheets, on this whole trade debtor line. Jevon Nicholson is asking if trade debtor is the same as receivables.
Yes. Receivables is, it covers all the monies that are owed to you, and you could narrow it down to trade receivables and other receivables. But the most significant parts of your receivables going to be your trade receivables. And as I state, I cannot overemphasize the point that in the current environment, a lot of companies are facing challenges with regard to be paying what they owe to businesses. And the cycle, there's connectivity between all of this. I'm unable to collect from my customers. I'm unable to pay my suppliers.
And that now brings us, of course, to the whole question of this concept of the financial ratios.
Yes.
Marc touched on that because so when you're reading the statements and you are looking and earlier shows we talked about the importance of collecting the receivables, even if it's a portion, because you want to get that receivables number down, because until you have the cash in hand, it doesn't mean anything. But as we're going through and viewers, we're seeing your questions. We're actually going to be addressing a lot of the questions, but we just want to get through some of the financial ratios. I want to touch on it. We can't leave here today and not touch on things like, what is your gross profit margin? Because some of us think is a different language. What's your gross profit margin?
Gross profit margin is the gross profit divided by sales. As I mentioned earlier, if I end up with a gross profit margin of 20%, in simple terms, it means that for every $100 of sales, I am generating $20 in gross profits. It is important for you to ensure that your gross profit is as high as you possibly can, because the fact that that gross profit is now going to be used to deal with and to cover your operational expenses. Also, your gross profit margin provides an opportunity for you when you are pricing. So for example, if you were to purchase some goods that you're going to resell, you're going to say, what markup am I going to put on this? Am I going to put 20% markup? Can the market sustain that? This is important because the fact that you want to be able to generate sufficient to be able to meet your operating expenses. So your supply chain needs to be seamless in terms of reducing the cost associated with your cost of sales.
Okay, so in this COVID time, as business people are making decisions of how they go forward, and understanding of some of these ratios are important, because when you look at your gross profit margin, what is a healthy gross profit margin?
It very much depends upon the environment and industry in which you operate. If you are operating in a highly competitive environment, you are not expected to have a high gross profit margin. However, you can, because of the fact that when we speak of a highly competitive environment, you've got no advantage over your competitor in that context. They can access the cost of goods in the same way that you can. However, it may be the case that you are a large company and you've got leverage. So therefore, if you are purchasing from a smaller company. I do not want to make reference to any companies in Jamaica.
That's fine.
But if you are huge and you've got power and you are seeking to purchase from a smaller supplier,
have leverage, and small businesses won't have that similar leverage.
Indeed.
Which actually brings us to, because we have the gross profit margin. Tell us the net profit margin. What are we looking at the net profit margin?
The net profit margin, and it's earnings before interest and tax. Again, I like to look at profit in the context of before interest and tax. And I made that point to you earlier with regard to why I like to do so.
Yes.
Earnings before interest and tax divided by sales. This is not one of my favorite ratios because of the fact that, but let me tell you what it is first. We're looking at it in the same way as gross profit. So we're saying that for every, say for example, we were to have a net profit margin of 10%. For every $100 in sales, we're earning $10 in net profit. In simple terms, that's what it means. But let me tell you the reason why I don't like this particular ratio. I don't like it because of the fact that you may find this difficult to believe, but I can make my profit to be whatever I want it to be, if you understand what I mean. That isn't much.
So gross profit margin is actually a better ratio as an investor for you to look at, because the net profit margin can be manipulated.
Can be manipulated. And let me give you an example how it can be manipulated. If you have got considerable amount of receivables that are well over 90 days, what you should be doing, you should be making a provision for bad debt, so that it will reduce your net profits. But what I could do, I could take a position and say, look, I am not going to
make a provision for bad debt.
A sufficiently large, yes. So my profits are higher. And
so audience, as we're looking and as we're growing our businesses and we're reading financial statements and we're looking at even the notes to the financial, at things like the bad debt provision, all of these are interlinked. And another ratio that we look at is return on capital employed.
Yes. Basically, what we're looking at here is the capital employed is defined as equity capital plus debt capital. So we want to find out what returns are we making on the total capital. And again, we're using earnings before interest.
Just to be clear, when we talk about capital, because I actually see a question from Phoebe Simmons Ranger here, and she says, could starter capital that you yourself loan to your business be considered as a current liability? So sometimes I think even as we're using the word capital, can we be clear what we're considering capital?
Okay, there are two sources from which we can obtain capital. We can obtain capital from equity, that is what I put in the business, or if it's
so my
shareholders
for the business is equity, is my equity in the business.
Yes, if I have it as ordinary shares.
In my business, that's my equity in the business.
Yes, you could describe it as equity. I put that in the business, yes. However, you can also make loans to the business, so you categorize that as debt. But for the most part, the funds that you put in the business is equity, yes. So as I stated earlier, we obtain, if we're looking at a company, a limited liability company, can obtain capital from two sources, from equity and from debt. So when we use the term capital employed, if it is the case that it's got debt and equity, the capital employed we're referring to here is debt plus equity.
All right, so what this help us to do? This one, this return on capital, how does this ratio help us?
It helps us in the context that basically, if I have put money in the business and I'm earning, say, 10% return on capital employed, and I could go and put the same money in the bank and earn 15%, I would be better for me to put it in the bank and go and lie down on the beach. Well, when the beaches are opened up.
Okay.
And I would not be risking my money at all, because
So
I'm earning 15% versus putting it in a business and earning 10% and taking a risk.
Okay. So what about the liquidity ratio? Sorry about that, Vanessa, that I interrupted Paul. We're just trying to get through quite a bit of information, so we'll get back to some of the questions. So Paul, can you tell us a little bit about the liquidity ratio?
In my view, the liquidity ratios are the most important ratios, because as the name implies, liquidity. If a company is not liquid, it could be making lots of profits and it could go belly up. So basically, liquidity ratios are looking at the extent to which the company will be able to meet its day-to-day obligations as they fall due. Cash, cash, cash. Cash is king. Cash is the lifeblood of an organization, of a company. So therefore, the liquidity ratios here are telling me the extent to which I can meet my obligations. So if I look at the current ratio here, it's current assets to current liabilities. So the current assets made up of inventory, receivables, and cash. Current liabilities, my payables and other payables. And if I've got a bank overdraft, now my current liabilities, they're due within 12 months. That's generally speaking what current liabilities are. So it's the case that I've got current assets and the supplies, payables said, look, you need to pay or else we're going to stop the supplies. It may be that I cannot convert all of my current assets into cash immediately, because if it's the case that, let me tell you what the cycle is with regard to current assets. You've got inventory. I've got to convert my inventories into receivables. Then I've got to convert my receivables into cash. Look at that cycle. So my liabilities are due. It's going to take me a long time. Well, it's going to take me probably considerable time to convert from inventory to receivables to cash. And it is even worse in a manufacturing environment, because in a manufacturing environment, you've got raw materials. So you've got to convert raw materials into work in progress. Then you've got to convert work in progress into finished goods. Then you've got to convert finished goods into a sale, which is now receivables, and you've got to convert receivables into cash. So therefore, that cycle is long.
And this liquidity ratio then is a very important ratio to consider in looking at that cash position of the company and the way the company is able to convert its assets into cash. I'm telling you, Paul, we are learning so much, and we have a lot of questions, and we're going to try to get through our questions. Our show is supposed to be 1 hour, but we're going to squeeze in. But since you are our audience and we are here together, just stay with us, because we want to get as many. So Vanessa just booked me and tell me I must interrupt. Sorry, Vanessa, but we are trying to get the information out. And please, viewers, we have this week a 23-page document that sets out everything you need to know about financial statements and certainly opens the window of your understanding. Email us at sme@psoj.org. We've had memos for each of our episodes, so please ask to get all of the memos to catch up on our episodes, and we're going to go through some of your questions now. Please keep the questions going, because we're going to invite, at this time, we're going to invite Marc, Gayle back and Nevada Powe, so that we can get to some of your questions and comments.
Hello.
Hello,
guys.
A lot of excitement going on.
A lot of excitement going on. So I just want to mention a poll. The poll is, do you do your financial statements internally or do you use an external accountant? 36% of our respondents said they do it internally, and 64% say they use an external accountant.
Rochelle, I want to comment on that actually, because even when you use an external accountant, and one can say that obviously it's a good thing, you should not delegate all the thinking. You should understand what it is that they're giving you. It is your business. It is not the accountant's business. And therefore, even if they're doing the books, do not abrogate your own responsibility to your own business. Especially if you're paying an accountant, let him teach you how to look at your financial statements. In fact, what I always tell the small businesses, let the accountant do it. Let the accountant show you how to create your books for 1 month and actually do the job of creating your books even once. Because that is the only way in which you're going to get into the detail to understand that when you can read it. And when you make errors, let him show you what to do to fix it. You must understand the guts of your business. So just to summarize again, because we've heard a lot, the income statement is about, am I making money? Your revenue should exceed your expenses, which gives you a profit, right? That's the goal. The bigger the profit, the better off you are. Paul talked about 2 different margins. There's the gross profit, which is when your revenue exceeds your variable cost. In the way Marc talked about it, right? That's when your coconut sales exceed the cost of buying the coconut. That's the gross revenue. Your sales exceed your variable costs. Then the net profit before interest and taxes, right, is when you minus your gross profit, the additional expenses in your business, and that should also be profitable, right? But that's when your revenue and your profit exceeds your fixed costs. Yes. And therefore, you know that you're in a healthy situation. Now, I've been in situations where I've seen businesses, one quite recently, where they have a very healthy gross profit and then a huge fall off in the net profit. That means the senior management is too expensive because they have overly done too much in terms of the fixed costs, because the gross base of the business is fine. So these are some of the things that you'd want to look at. Again, revenue exceeding expenses gives you profit. Revenue exceeding variable expenses gives you your gross profit, and the gross profit minus your fixed expenses gives you the net profit, right? Just to be clear. The balance sheet is about your net worth. What do I own minus what do I owe? Which basically then says is what I would have when everything's gone and left over. What's left for me? That's the balance sheet. And it's always a snapshot, meaning it's what is it now, 2 weeks from now, a year from now, whatever it is you track, that balance sheet. And third, Marc talked about this, the cash flow statement. The bank is a very good place to understand that, right? How much cash is coming in and how much cash is going out and how much cash do I have left? You ever see anybody go to the ATM and praying? When you are praying at the ATM, it means you do not have a cash flow view in your mind, because you should have known my salary went in, my grocery bill went out, my JPS bill went out, and this is what I have left over. If you are praying when you go to the ATM, you do not have a cash flow view of your life. How much cash comes in, how much cash comes out, and what do I have left over? Very, very critical that we understand these 3 statements: income statement, balance sheet, cash flow statement.
Okay, so Nevada, in giving that summary, I just want to open up some questions now to our viewers. I saw a question earlier in regard to Adrian Rudd actually asked, what are the top 3 indicators you would use to assess business health from the financial statements in this COVID period?
Paul, you want to tackle that?
Yes, basically, I would look at the gross profit margin. The reason why I look at the gross profit margin is because the fact that I want to find out how efficient I am in terms of my pricing and how efficient I am in terms of sourcing my cost of goods sold. Yes, I want to be very, very efficient in those. I'd also look at my receivables. How long is it taking me to collect from my customers? If it is a case that my credit policy is 30 days and I've got over 50% of my receivables over 90 days, I'm beginning to get a bit worried, because the longer the receivables take to be collected, the higher the probability that I will not collect it. I'll also like to look at the payable days. How long am I taking to pay my suppliers? If I'm taking a very long time to pay my suppliers might say, hello, sunshine, cash on delivery. So basically, the cycle is I cannot collect from my customers, I cannot pay my suppliers, and now he's asking for cash and delivery. And the next ratio I'd look at is what is called the gearing ratio, leverage. What proportion of my capital is debt capital? Yes, the reason why this is important to me is because the fact that if there is a downturn in the economy, I've got to be still paying interest on my loans. And I've got to be able to generate sufficient revenues, cash, earnings, call it what you may, to be able to pay the lenders of loans. Yes, so those are the three that I would looking at very closely, because there are lots of risks, and this COVID-19 has highlighted considerable amount of risk that companies did not think of. And the whole environment is going to change. A lot of companies that looked very attractive a few months ago to invest in, they don't look so attractive now.
Thanks for that, Paul.
And just to build on that real quick, Rochelle, you know, so in terms of those ratios that Paul just spoke about, you know, if you think about it, particularly in COVID times, right? So you think about your gross profit. Your gross profit is what you have left after you've paid for all of the inputs in whatever you're selling to do to build your business, right? So typically, whenever the economy is going through stress, the first thing that people tend to do is offer discounts, right? So when they cut prices and they offer discounts, then your gross profit margins get squeezed. So if you're looking at a company that you want to invest, or you're thinking about it from yourself, particularly in the space of COVID, your gross profit margin will tell you how much discount can you afford. You know, and some people, if they don't really understand how much discount they may cut too deep, right? Or sometimes you need to cut too deep so that you can get rid of the inventory, right? So and then the discount,
informed decision.
Exactly, right? So if you give a deep discount, that may allow you to go through your inventory a lot quicker, which allows you to convert into cash a lot quicker, because you need the cash so you can pay your interest, you know, on your payments, so you don't default, right? So I absolutely agree with Paul, and you know, just again, gross profit margins, you know, your overall you know, structure of everything, and then also, you know, obviously your balance sheet and how much debt are you paying and so on.
Okay, thanks for that, both Paul and Mark. Paul, there's actually a question here for you too. Can Paul discuss how a person could adjust their capital structure to reduce cost of capital by focusing on NPBIT?
NPBIT, net profit before interest and tax. Basically, if you've got significant amount of debt in your capital structure, then you could go to your banks and said, Mr. Banker, I am facing some challenges here. I'd like to restructure my debt so that it doesn't significantly impact my business. Mr. Banker will enter into some negotiation and discussions with you, because in the long run, Mr. Banker's loan is at risk. And he may want to, rather than say, come in and wind up your business, he might want to work with you to ensure that your business continue in the long run. So therefore, you could restructure your debt if you've got considerable amount of debt in the capital structure.
And another aspect to that, to Rochelle, is if let's say you took on debt 5 years ago, and this is particularly apropos for Jamaican businesses, where we're coming from a very high interest rate environment, right? So if you took on debt 5 or 10 years ago, and the interest rate was 20%, 25%, well, now interest rates are much, much lower. You can either go back to your bank or go to another bank and refinance your debt, right? So you can basically take out the exact same amount of debt that you currently have at, let's say 10. And just by doing that alone, that will increase your net profit, your NPBIT, right? Because you decrease your overall interest burden.
Of course.
Nevada, I see you nodding. Do you have anything to add to this section?
No, it's actually very good. The assessment is perfect. Yes, for sure.
I am seeing here a question from Christoph. So Christoph says, a lot of times you see some big numbers on company statements and can't tell if they're supposed to be even bigger or not. Are ratios the way to get a better understanding of them? Nevada, are ratios the way to get a better understanding?
Well, okay, so here's the situation, right? That's why the history in the financial report is also what's critical. Should they be bigger? One of the things that you do, for example, just even taking something as simple as the top line, the revenue. You're looking at the 5 years of revenue, and you're looking at a number, whatever it is for 2019, which is the last full year that something was available. So if they're doing something where 2016, 17 higher than 16, 18, 19, 20, that's, then that's a growing business situation. And of course, you look at the notes to see what has exactly happened. Have they increased prices? Are they selling more units? Whatever it is that has occurred. So remember, each of these numbers, you're not just looking at it in isolation. No, so that's the first thing when we look at the numbers, that the history of the numbers is critical. By the way, as an SME, when you go to the bank, they also want to see your history, right? Because they want to know if your business is growing or shrinking or erratic. Because, by the way, erratic itself is not generally good unless it's clear again why it's erratic. For example, during COVID, which is what we're likely to see. The ratios in those situations now will talk to you about the stability of the business over time. And again, you want to look by history. So for example, if I see a situation where the gross margin or the net margin is actually increasing, which would be a good story, I'd want to find out why. And they could say things like, actually, my supplier, what I could pay for supplies previous years has now gone down, and therefore my business is more profitable. Or if it's shrinking, you want to say my supply, as cost of my supply has actually gone up. But these are very critical. Somebody had asked a question, maybe you know Christoph earlier, about two different businesses. So we've seen situations, for example, right now, two different caterers, right? One at 100 million in revenue and one at 40 million in revenue. And the $40 million one in revenue is making far more money than the 100 million. And he said, how is that possible? And it's about cost control. And it's actually at the variable cost level, because if you think about when you put together a plate, you actually have to know, if I put in one piece of tomato, one piece of meat, the size of the meat and stuff, to know the cost. Because if I put together a meal and then charge, for example, I say $500 for this meal, but I don't actually know, I could be literally losing money every time I send a plate out the door. There's the other caterer who's making much more on the 40 million. What this caterer does, he knows down to the difference between a half a slice of tomato and a full slice of tomato is profit. So he knows the cost of every single thing on that plate. That is someone who's focused on the margin. This is why I tell you, why are you in a business sometimes where you see yourself working hard and not making any money? It's very often is that you have not understood your cost structure. And you have to go back to understand it. By the way, the cost structure, that stuff, their accountant is less likely to understand, because their accountant, again, is looking at aggregate levels for the most part, right? Is you are going to say, you know what? I was using too much tomatoes and the price of tomatoes gone up. And therefore, that's why my cost has gone up. No tomato in the meals this month. So you have to understand your numbers. Very, very critical.
Can I say two things real quick? One, I fully endorse that, Nevada. I mean, there are two things, right? The first thing is, I never ever look at numbers in terms of big or small and take them at face value. You have to do analysis on them, and even growth rates. Like, so for example, if you see a company that is growing year over year 10%, even that in a vacuum means nothing, because the industry could be growing at 20%. If the industry is growing at 20% or the market is growing at 20% and the company is growing at 10% year over year, there's something structurally wrong with the company, right? So you have to understand what is the context that the company is performing in. Also, how is it doing relative to its peers, right? So that's point one. And then point two, in terms of, one of the reasons that, so as Nevada had mentioned, Rochelle mentioned earlier, I do offer classes. So if anybody wants, to find out more information about this stuff and learn more, you can always, you can check the link on the screen right now. I have a bunch of classes, or you can email me. But one of the things, the reason I'm so passionate about this is that once you understand the way this thing works, your entire business is going to improve. So for example, in my case, whenever I'm doing my books with my accountant, I never, ever, ever get one set and then that's it. It's always multiple revisions. I have never in my entire life just saying, okay, take all of my receipts, take all of my invoices, and then just give me a thing, and then I treat it as a Bible. Never. I always take it, scrutinize it, look at it, say, okay, is my cost of goods for this product really this? Are my gross profit margins really this? And how can I improve this? And I scrutinize every single thing, and then I go back and forth with my accountant until I come up with a true picture of how my business really and truly is working. And so understanding all of this stuff, is extremely empowering, because at the end of the day, the accountant will not know your company the way you do. There's no way.
Yeah, and Marc, I actually like how you put it a moment ago. You said it's understanding these statements is empowering. You didn't just say it's important. It's actually empowering because it puts you in a better position with your company. Paul, you're going to jump in?
Yes, I was going to make a point, is that you alluded to it earlier, that a lot of companies, they just operate until it comes to year end. And they say, hello, I'm not making any profits here. What I always recommend is that you do monthly in-house management accounts. And you can tailor those accounts to whatever your needs are. You need not follow international financial reporting standards. You could say, look, this is what I want to know. I want to know how much fixed cost there is. So therefore, I need to know how much revenue I should generate to break even. So basically, I always recommend monthly in-house financial statements and also budgets. What am I comparing my actuals with? Did I budget for this, or am I just going along and sticking my finger in the air, hoping that everything will work out well? You need to get a handle of things, and you need to monitor your accounts, your financial statement on a monthly basis. If it is the case that monthly is too frequent for you, at least go for quarterly. But don't wait until year end and you say, hello, I haven't made any profits at all.
Absolutely. One of the things I wanted to just make sure, just as Marc talked about his class, that Paul actually has a seminar coming up. Do you have a slide on Paul's seminar on finance, understanding financial statements? It's July 28th and 29th. It's 2 days, 8:30 to 11:30 a.m. It's going to be online. The cost is 25,000 Jamaican dollars. But many of these more complicated questions, Paul is where you can get a lot of these things answered. When people talk about consolidating debt and doing all those kinds of things, this is where this is the kind of seminar that you actually want to go to. It's very clear, Rochelle, that we are going to need a part 2 on this topic because there is a lot of interest
here, and we did not touch on forecasting.
Yes.
Vanessa mentions that forecasting also helps, because forecasting is very important.
Yes.
So I think we are going to need a part 2, because Nevada, you talked about cost structure, and you also mentioned that your accountant, you have to know your cost structure, not your accountant. Your accountant can't tell you if you're making any money, but you have to understand your cost structure. So this looks like a part 2, because there's still so much that we were not able to touch today.
Yeah.
Now, one of the important things, though, is that the show actually goes through some of the important highlights from the memo. I highly recommend that if you have not yet subscribed to the memo, both Marc and Paul have contributed to the memo this week. So they have even further broken down a lot of the things that we have discussed. So stay informed with the PSOJ, get the weekly business tips memo. Email us at sme@psoj.org. We have looked at the various comments that have come in, so we recognize the other areas that you want to discuss, but we want to hear from you. Please send in your questions and your comments. Share, watch this video again when you go and watch this video. In fact, look back at our previous videos, because a lot of the things that we discussed earlier are actually coming to fruition now. Paul talked about the whole question of the trade debtors or the receivables. You remember Nevada in the very first show said, please sell off the inventory. Mark mentioned when you're selling off the inventory, you have to know what your gross margin is. So if you're going to dig deep into it, you know that you're making an informed decision. So today was about opening the window of your own business. It is not sufficient that your accountant just gives you some financial statements and you sign off. Be empowered and understand. So I just like to mention again, because I know we want to get the learnings. Can we just put back up the information on Marc's course as well as the information on Paul's course? So Paul's course, Understanding Financial Statements, comes up at the end of July, July 28th to 29th. It's online. So our diaspora viewers, we're looking forward to you joining Paul's course. And Marc also has a course, and Marc's course is Marc. Sign up for Marc Gayle's financial masterclasses to learn how to analyze companies, read financial statements, make better investment and financial decisions. And the link is available. And we really appreciate your comments. Christoph Ellis says the math in that sounds scary to a lot of people. Basic financial forecasting would be good. I see a lot of people asking for that. So Nevada, get your forecasting hat on, because as we're looking to know the next couple of months of COVID, there are some new decisions that have to be made. And some of us, Marc, have to throw out the old forecast that we had done for the year in January. And as Nevada says, some of us have to be forecasting on a daily basis based on what is happening. So I'm going to give each of you gentlemen 30 seconds. Nevada, because of you, I'm going to give you 1 minute. So Paul, I'm going to start with you. What would you like to leave our viewers with today?
Before I tell you what I'd like to leave your viewers with today, the course that I will be conducting on the 28th and the 29th of July is in collaboration with the Jamaica Institute of Financial Services. So if you wish to get more information, you could go on their website. I would like to leave with our viewers that they need to ensure that they keep a very close eye on their financials, and they should not just wait until year end to actually prepare financial statements, but should do so at least every quarter. Pay very close attention to your receivables, pay very close attention to your gross profit margins, your liquidity, and your debt.
Thanks for that, Paul. Marc.
Yes, ma'am. Okay, so I guess the biggest thing that I would leave with everybody is like, I know that accounts and finance sounds intimidating, but it's not. Like, once you push past a hurdle and you really kind of get to understand it, it's liberating. It's like learning to read. Once you understand how to read financial statements, you're not going to believe how much you've missed, all of these years, and so I strongly believe that the way to economic independence in Jamaica is for more people to become financially literate, especially, not just our entrepreneurs and our SME owners, but everybody generally. The more people become financially literate, is the better the country is going to be. And so, this is why I'm a huge advocate for increasing the financial literacy, which is why I do the courses. But you can follow me on Twitter at Marc Gayle. You can engage with us. We have a hashtag #FinanceTwitterJA. So big up all of the Finance Twitter JA people that are tuned in. But yeah, come on Twitter. You can engage with us. We talk about a lot of stuff free. And then if you want a more structured course, you can email me marc.gayle@gmail.com. Or you can go to the URL that was on the screen earlier, gumroad.com/MarcGayle, and check out my courses.
Thanks a lot for that, Marc. Nevada.
Yes, ma'am.
Nevada, you don't have no course?
No, I don't have the course we have is COVIDCAST. Thank you very much, guys. Thanks, Marc. Thank you very much, Paul.
Thank you very much, Marc. Thank you very much
for having us.
Excellent.
Yes.
Excellent.
So Nevada, I know that I don't want us to wrap up and forget that there is a very important online conference that is coming up that the PSOJ is hosting.
Yes. So on the August 14th, sorry, I just want to wrap up something on the thing that we said. Do not be afraid of accounting and finance. Financial literacy is very, very crucial.
Nevada, I'm going to interrupt you because I know why you go talk about the online conference and your parting parables are not heard. I want you to hold your parting parables so people can sit down with their notebook because you know you're right wrong.
Okay, on the August the 14th, the PSOJ is hosting a conference basically on the economic recovery, how to plan for the economic recovery. It is very clear to us, and Rochelle, you and I sit in many meetings, that we will continue to face what we call it, the jugo economy, right? Very scary, for example, what's going on in America, and the number of, in the last 2 weeks, 1 million people have gotten infected, right? So that is our primary source market for our primary industry, which is tourism. So we're going to have to recognize that any plans and forecasting that we are doing is going to be difficult. And therefore, we have to think about the entire ecosystem. How do we manage to ensure that at the end of 2 to 3 years, and the reason you use 2 to 3 years again, is when we have a vaccine that is widely available. How do we ensure that at the end of 2 to 3 years, we have sufficient industries, sufficient businesses that can actually regrow into a developed economy, right? Because if we just don't get organized around it, we're going to see a lot of businesses that are viable before COVID, would have been viable after COVID, but cannot manage the 2 years in between. The entire conference is getting together people in the public sector. We're getting Governor Biles from Bank of Jamaica. We're getting people in the private sector. The banks, SMEs will be there. Big corporate businesses will be there, in order for all of us to come together to hear what the issues are at a granular level, in order to begin to have a national discussion. How are we going to ensure that at the end of 2 years, we have a robust thing ready to spread? It's August 14th from 9 or 9:30. I forget, that's still being worked out. There'll be very great
5 p.m.
9 till 5 p.m. All kinds of different players. We also have the IDB coming, all kinds of different players to just help us grapple with these problems. Recognize, by the way, that we're not coming with answers. Some of it is just raising the issue, grappling with the questions, seeing some of the answers that we're going to be able to come up with in our group, and recognize that this is going to be an ongoing conversation. The PSOJ wants to ensure that all types of people in the public sector, in the private sector, big companies, small companies, become part of that discussion. And that's why we're launching this, and it will be online.
And it's going to be online. And SMEs, as business people, when we're looking, and we know that taking 9 to 5 of your day, you're saying, wow, that's a long portion of the day. But guess what? As we're doing the planning for our business, we're empowering ourselves by being at the table and being a part of the conversation, because we need to know what decisions are being made and what are the considerations, and we need to have an input. We can't stay on the sidelines and then just have the things happen to us. We have to be an active part of the conversation. I'm seeing Shelly and said the information was thoroughly presented and brought greater appreciation for financial statements. Great job. Looking forward to a part 2. So before we get to part 2, Nevada, I know you have some closing words, and I just want to say to our viewers, thank you for your engagement tonight. It gives us life, and as we continue to bring the information forward, and we just want you to know that at episode 16, we were at 1.5 million viewers. So the information is getting out. So continue sharing, commenting, sharing with a friend, ensuring that this information is getting out, because we are empowering each other. Nevada, what are you leaving us with tonight?
Actually, Rochelle, I just want an interesting thing just on that comment. So I got reached out to by a small business group in Houston, Black business people, and apparently they've been watching the show. And I said, and that's really interesting that you in America would watch this. And what they said was, you don't get a lot of business shows in America with Black people speaking about business. So Black people in America tend to speak about social issues and cultural issues. But the idea that there is a business program with this kind of level of guidance and detail is something quite innovative. So I think that's why we're seeing viewers in the UK, in Canada, in America, across the Caribbean and so, because I think the whole notion of Black people discussing business sensibly, which in Jamaica, of course, it's normal for us, is very, very crucial. So here's the thing. What I started at the beginning of the show is lots of us do not understand finance. And anytime you ask a question about finance and somebody try to pull the wool over your eyes, use bigger words, what was the discounted cash flow? You say, stop. Do not allow anybody to intimidate you about your business. Do not allow them to continue to discuss if you have not understood A, B, and C, and certainly not in the case of a banker who you're trying to get loan from or an accountant who's working for you. If your eyes are glazing over, let him start again. Let him or her start again. Again, your income statement is, are you making money? And if you are not making money, are you losing money at the variable cost level or at the fixed cost level? But this is what you need to do by looking at the income statement. Your balance sheet is about, are you increasing your net worth? What do you own? What do you owe? And what's the difference? And are you building wealth over time? You and your business. And third, cash in, cash out. Managing your cash and making sure that you are actually in a situation where your cash flows are positive. Rochelle, fantastic show. Really glad people engaged because finance is one of those topics that people like, as you said in the beginning, big yawn, tired, can't bother to listen to this. But very, very crucial, as Marc said, that we become a financially literate country. And PSOJ and COVIDCast are here to guide us down that journey. Please remember, we answer questions even after the show is done. We get the experts to answer questions even after the show is done on the comments. If you feel the need to watch it again, it's always here. Please join us. Stay on top of your business. Good luck to everybody.
Yes. And remember to email us at sme@psoj.org if you currently do not get the subscription of the SME memo. It's a weekly memo, and you must ensure that you're a part of this. So, business owners, business people.
By the way, I think Christoph said, Nevada out here draping up everybody.
I was going to say how you're draping up everybody. But you know, Christoph, one of the things we want to add tonight is that many of us don't want to make the start. We say, but I didn't understand this before. I've been in business for 10 years. Start tonight. So tonight you've gotten a lot of information, so you are in a better place to make decisions. And many of us, even as we're making decisions of whether we close our business, do discounts, pivot our business, we cannot make those decisions wisely if we are not understanding the financial position. And remember what we say in this show, ask the questions. There is no question that's a stupid question. The only stupid question is the one that you did not ask. So we are looking forward to you joining us again next week. And we're really going to have to look at the part 2 because we have so many more things to discuss on this topic. So thank you for joining us for episode 18 of COVIDCASTJA. This is our new time, 7:30. So for those of you who had missed a couple of episodes and had wondered where we were at 4 o'clock, we are at this new time, 7:30. So today we discuss how to create and read business financial statements, and the episode will be up for you to watch. And we encourage you, rather than binge watch on Netflix, cause this to be your Netflix and binge watch COVIDCASTJA, this business program. So walk good, keep well, and ensure that tonight you are not just going off to sleep, but you're taking a look at your financial statements. See you again next week for another episode of COVIDCASTJA.